This video and all other videos on this channel for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and we're back with another weekend's deep dive in case you are new. Every Saturday we come back and we re-examine the base case hypothesis of the channel and we just check to make sure everything is still going according to plan and according to expectations. Of course, if it's not, then I want to know in the first instance so that I can figure out where I'm going wrong and start to look for invalidations. And ultimately, I don't care about being right or wrong. I only care about staying on the right side of the market. So far, I think so good. Every now and again, we get a wobbly print somewhere. And I think we kind of got that in the CPI this week. So I'm going to touch on that. I'm going to spend a little bit more time on that than usual. Other than that, everything still seems to be largely speaking going according to plan. So from the top, for the stock market, the expectation was that the lows, we would have a big blow off top to new highs. We would see rate cuts sometime around the top within a few months, say, and then we would get a rollover into a bear market and global recession. Not only have we had that run up, and of course we've seen the onset of the cutting cycle close to the top, assuming the top is close and it doesn't just run for many, many more months to come. It's been occurring against a backdrop of people suggesting that this is the early stages of a melt up. Meanwhile, the total stock value market cap to GDP ratio is at all-time highs and is sitting around 200%. So I continue to make the case that it is not early in the cycle, and in fact we are getting dangerously close to seeing tops come in. As Andrew points out here, we get a periodic top every 17 years in the S&P 500, or the stock market in general, and thus it is more than reasonable to expect from a cycle perspective that we will probably spend the following year in a red S&P 12-month candle. There's also an Elliott wave count here from Big Mike that supports this, okay? He says, I don't know, I give it a month more max before all hell breaks loose. And of course, if you've been following this channel for any length of time at all, you know that fits my expectations as well. So we will continue to stay long and strong all the while we have reason to do so, okay? All the while the charts have not broken down, all the while we're still holding trend lines, and all the while we're still trending up in higher highs and higher lows without failing the daily cycles. I will continue to stay long and strong in the stock market, but every week I come on here and say, look, we're already in that third and final blow off top angle, and needless to say, hopefully, right, I don't think this can go on forever. So let's see, right? Let's see. But so far, so good. I'm going to tick the stock market off and say happy days there. For Bitcoin still remains the one component that didn't quite play ball for me. As you can see, I was expecting this huge parabolic blow off top, an all-time high before the halving, and then ultimately a top to come in before November of this year, qualifying it as left translated. Since we're already in November now, we can happily say that we are not going to get a left translated cycle. And so I pivoted my stance to, instead of accept this as the base case hypothesis for Bitcoin, I said that we're essentially going to do the same thing. It's just we spent way more time in here, as Tony the Bull points out. But according to this schematic down the bottom, I've been saying that if indeed this is in play, and I believe it is, then we should see a near vertical advance for Bitcoin start to unfold. Anything other than that, and we could perhaps say that this is not the situation we've got going on. However, needless to say, at the time this was posted, you can see we were trading at 65,000 bucks. Today, of course, we are trading way closer to 90, 91, 92k. So this thing is starting to look an awful lot to me like it is underway, well in play, and so long as this thing continues to squeeze, then I continue to stand with this as the base case hypothesis, which wouldn't have been too different from this. It's just we got to here, we did this, and then hopefully, if I continue to be correct, we will get a big blow off top move that ultimately resolves to an extended bear market decline, because there is more time left in the cycle than the normal 12 months we're used to seeing before we can find that 4-year cycle low in 2026. Objectively speaking, I got that part wrong because I was expecting this leg here to occur from either here or here, and of course it took a little bit longer than I expected, but so long as this continues to play, and like I said, we're already about halfway there, then I continue to accept this as the primary hypothesis for Bitcoin. For inflation, I've long been making the case that anything you do to the M2 rate of change shows up in the CPI, albeit with a lag. We did really, really well at suggesting that inflation CPI would trend down, sideways, and continue down, since that's what we saw here, here, and here. What I have here is the CPI inflation data minus the most recent print. And as you can see, we started to look an awful lot like we got this right, okay? We went down, sideways, and down. So it was a case of happy days until this week when we got another CPI print come out. And that CPI print came in at 2.6%. So not what I was expecting. I was expecting a much colder print. You can pause your screen and take a good look at the data here if you are interested, but the long and short of it is 2.6 was significantly higher than I was expecting to see. So of course this begs the question, Camel, are you invalidated? Camel, is this a problem? Camel, is this a short-term wobble? And of course the simple answer is nobody knows yet, okay? It's far too early to tell. We can't just allow one wobbly print to show up and then for me to throw the whole idea out the window. We have to continue to take it one day, 1 week, 1 month at a time. But I actually have some quite interesting data to share with you about this, because we have been making these kind of jokes consistently throughout this whole inflation-deflation cycle. Okay, now, I said yesterday, one print of 2.6%, and that 70s inflation fractal comes right back. Okay, so if you don't know, the dotted one is the 70s inflation fractal, and it's got a lot of people thinking that we have just begun this next leg to the upside, and this is what we're going to see going forward. If anything akin to this is to show up, then I will have to hold my hands up and say that is a hard invalidation on my inflation expectations. I will have to hold my hands up and say that I was flat wrong, because I'm still expecting this to show up. We also noted divergence in trueflation, okay? Trueflation made it all the way down to a one handle for the prints corresponding to the most recent CPI data. So the divergence between the 2.6% that was reported by the government and the one handle shown on inflation around the same time really did throw a spanner into the works. But stick with me, because I'm going to show you in a minute that actually I think trueflation is far more accurate than the government's reported rate. Something else of note is the most contemporaneous trueflation data has shown a significant increase at 2.78%, which I think potentially sets us up for a bit more of a counter trend bounce here. And of course, if that is what we see, it suddenly gives a whole lot more credence and credibility to seeing the 70s inflation fractal play out. However, as I said earlier, I still think that the people expecting this are flat wrong, and I'm going to show you why now. I still think the most probable outcome here is, even after a counter trend wobble, we continue to see inflation resolve towards deflation. I still make the case that the real risk here is deflation, not resumption of inflation. So, like I said, let me show you exactly why I think that. So whilst headline CPI came in hot month over month, which was also the highest month over month read in 6 months, plus 0.24% month over month, that's actually the same level that was typical pre-2020. Okay, so when we pull up the chart right here, you can see not really super alarming. Okay, speaks to roughly the same sort of inflation that we used to see in before everything started to go Pete Tong. Headline CPI went up 16 basis points to 2.6%, but believe it or not, this is still within spitting distance of the Fed's implied 2% inflation target. And so, of course, the question becomes, hey, Camel, how can 2.6% be within spitting distance of 2%? And the answer is quite simple, because the Fed is not targeting 2% CPI, but 2% PCE. And historically, a headline CPI of 2.5% corresponds to 2% headline PCE. So you can see we're actually only 8 basis points away from the implied 2% inflation target as it stands. Core CPI came in at plus 2.8% month over month, which was actually the lowest read in 3 months. Despite it rounding to a seemingly higher plus 0.3%, core CPI month over month reads are in a clear downtrend, as you can see right here, clearly making lower lows and lower highs. And again, I like to remind investors here that short-term counter-trend bounces within the context of a primary trend are also observable in macro data sets, not just in stocks, securities, and assets. Core CPI went up to 3.3% year over year, which is the smallest year over year increase in 3 months. This is after being in a downtrend for nearly 2 years. Core CPI went up a little bit over the next 3 months, which seems like the progress on core inflation might have stalled, i.e. we might be experiencing sticky inflation, but that is absolutely not true. And the reason for this is shelter continues to be a problem child. Shelter is the biggest lagging component in the entire basket and is a flawed statistic because it lags more than 2 years behind actual rent inflation. Shelter is still showing 4.9% year over year, while market rent measures are much lower and even negative, such as the ALNRI, which is at negative 0.7% year over year, and it has also been like that for 1.5 years. So if we take a look at the difference between shelter as reported in the CPI basket in blue, still very, very sticky, still around 5%, versus the real-time metric ALNRI in red, which as you can see at the bottom, has been deflationary for 1.5 years. And so if we were to swap out shelter with a more real-time metric, both headline and core CPI are at a 1 handle. Suddenly, that trueflation print on a 1 handle starts to marry up with the real world data. So we are currently well below the 2% inflation, and moreover, we have been for almost 1.5 years, as you can see right here, okay? So I still make the case that the Fed is late to cut. I still make the case that the Fed continues to try to make things look like they're not as bad as they really are, and I continue to make the case the real risk is deflation, whilst the entire rest of the market seems to think that the base case here and the most likely outcome is resumption of inflation. It's in my opinion that it will be very, very difficult to see something like this manifest without an outright return to QE and Fed balance sheet expansion. And as a friendly reminder, we are still tapering the Fed balance sheet. So all of this data likely supports a 25 basis point cut in December. Of course, we'll continue to track this in real time and see if that's actually what we get. But assuming we do, I would like to also now remind you of the next part of this base case, which is that the current cutting cycle that the Fed is undergoing are not cuts into normalization with a soft landing. Yes, perceptively, that is what we have right now. We have inflation returning to target, and we so far have apparently avoided a recession against the backdrop of the stock market lulling investors into thinking that everything is fine and dandy because people are making money hand over fist. However, once again, I make the case that these are not cuts into normalization and are in fact cuts into a slowdown. And the last 3 times we saw cuts into a slowdown, here, and here, okay, it corresponded with significant drawdowns in the stock market. So I make the case that we are very close to completing this final leg to the upside, and then times are going to get quite difficult going forward. One of the supporting elements for this is this current Fed rate cutting cycle is occurring against the backdrop of the yield curves, which have been inverted for a record amount of time, now reverting back above the zero line and starting to move to the upside. Every other time we saw this, okay, we got significant drawdowns in the markets. Is this time going to be different? I personally don't think so. And as I wrote here, this is against the backdrop of people saying things like we are in the early stages of a bull market. For the record, this is the 10-2, and if we want a sharper, more real-time signal, we can use the 10-year 3-month. This hasn't quite reverted back above the zero line, but is well on its way. And usually when it does, okay, stock market tops are incredibly close. Once again, I think when we point at this chart, objectively speaking, we do indeed have a parabolic blow-off top unfolding. I really don't think there's a great deal of time left. And I would be really quite surprised, to be frank, if this market is still moving to the upside into Q1 of next year. I really think that they are most probably going to rug pull this before the end of this year. So as ever, I'm open to being wrong about that. I'm open to being long and strong as long as the market continues to move up. But if we get some time in the next, 4 weeks, 6 weeks at the most, and then we get a third and final angle breakdown, watch for it to be confirmed with failed daily cycles. And then I think times are going to get very, very hard, very, very quickly. And again, I suggest when we look back in hindsight with the record yield curve reversions, with the cuts into a slowdown, with the Fed behind the curve for inflation, I think it will all seem pretty obvious. Needless to say, if we are going to have a bear market and a global recession, we would need to see labour market deterioration, which makes up the next component of this hypothesis. There's no real changes to this, okay? The Fed continues to butcher the data. And as you can see through all of these prints from January 23 up to October, had a total downward revision in the jobs, just shy of 500,000. So they continue to make the data not seem as bad as it is. I make the case because they don't want investors to start to see the warning signs, just like I make the case that they are messing around with the data, right? Because they don't want people to know that we are dangerously close to a deflationary bear market. We can see here signals for non-farm payroll in 2007 both gave us the first flash of negative, the first flash of negative, and that corresponded to one final high in the stock market before that was all she wrote, one final high in the stock market before that was all she wrote, and right now we've been negative. Okay, so I expect the black to do something like this, and I expect this to occur on one final high before that is all she wrote. Again, when we look at the charts, okay, if you disagree with this, it is in my humble opinion what you are essentially saying is we're going to do this indefinitely. I don't think that is realistic. But again, I'm not trying to convince you of anything or sell you on anything. By the way, whilst we're here, I think oil is also showing us, okay, does oil to you look inflationary? Does it look like demand is picking up, a booming economy? No, it looks a lot to me like it is getting ready to have a downside flush. And again, it does not seem to believe the sticky inflation prints like the majority of the market seems to. We also have been monitoring the SAM real-time recession indicator. Okay, right now we're at 0.43 and we need a 0.50 to be truly in a recession, but it has triggered a value above 0.5 last 3 consecutive prints. If we look at the hard right edge here, that seems like a clear uptrend to me. So of course it could turn down, okay, but it hasn't done it yet. Something else that we have been monitoring in real time is the high yield credit spreads, okay? Now, objectively speaking, this is a massive compression, okay? Looks absolutely nothing like financially stressed conditions where we get a big spike. But one thing I do know from being a breakout trader for a decade and a half is the more compression we get, okay, the more explosive this expansion is going to be. And again, I think when this starts to break out, particularly against the backdrop of the stock market breaking down from its third and final angle, all of this is going to look quite obvious in hindsight. And all of this continues to be against a backdrop of record credit card debt in the US. Okay, the consumer is in bad shape, and when the consumer is in bad shape, it cannot spend and stimulate the economy. It's also seeing the personal interest payments, which is at the red, okay, not a good sign. And that is against a backdrop of personal savings at lows, okay? Again, not a good sign. The consumer is not in good shape. How are we going to continue to have a booming economy and meet these earning expectations that are ridiculously high going forward when the consumer doesn't have any money? And we can see how bad this is because we are getting auto loan delinquencies, which are, by the way, over $1.6 trillion, starting to reach default and delinquency levels not seen since the GFC. And again, fitting in with this theme of cutting into a slowdown, okay, this is ISM manufacturing PMI has been recessionary for nearly 2 years now. Again, I think if this thing is to come tumbling down at the end of this year, then in hindsight, it's going to be very obvious. Now, having said that, everything is obvious in hindsight, right? Hindsight is always 20/20. But the reason I like to continuously express this as an idea is because we want to be able to look forward into the future so that we can stay on the right side of the trade, okay? It's no good watching this whole thing come tumbling down from here, okay? Get somewhere in this neighborhood and then go, maybe we could have seen that coming, okay? I like to project forward and look back in time because if something like this is on the table, then I want to be getting out in the first instance as close to the top as possible. I don't want to be waiting for something like this to unfold, okay? And then all the way down here going, maybe I shouldn't have been buying the dip the whole way down. Maybe the writing was on the walls, okay? So wholly speaking, before we do the TA, I would suggest to you that everything is more or less going according to plan. If we start to see inflation actually stick, okay, if we actually start to see a whole heap more of this, if we start to get something akin to this fractal playing out, okay, then again, that will be hard invalidation and will require reassessment. If somehow we start to avoid significant labour market deterioration, okay, they don't have to keep revising the data down quietly thereafter, then again, that will be a hard invalidation on this. If for some reason the stock market can continue to climb this wall forever, right, or even break down on the first one, hit the second and continue to grind that, then again, we'll be able to buy breakouts and stay long and strong the whole way up. But so far, I think everything is more or less going according to plan. And if we can just get one final squeeze and then a breakdown in the not too distant future, all of that will be perfectly in line with the expectations, especially if for Bitcoin, what we can get is a big violent push to the upside, something like this, a throw over of the channel, and then an extended bear market decline into that 4-year cycle low in 2026. So I have no problem with my current posturing, which is long and strong across the board. We continue to trade in and out of the stock market and Bitcoin and a bunch of other assets, and I have no problem being net long across the board right now. You can see my yellow squiggle kind of makes the most amount of sense to me. A daily cycle low in the not too distant future for the S&P 500, and then I think we're going to get one final high, and then it is probably going to be time for me to start to think about calling tops. I saw a lot of bearishness out there for the NASDAQ and the stock market in general. People are saying, is that the top or whatever? I don't think it is. I think we're just backfilling some gaps and we're going to resolve to the upside out of the cycle lows in the not too distant future. Same deal with the Dow, right? I expect a little bit more of a pullback and then a bounce. The same deal for the Russell 2K. I could see it backfilling this gap and then continuing. I've drawn an upward sloping red line of support. Any trade below that and I will close this trade out for profit. I do not really want to see any breakdown below that upward sloping red. And we managed to get a little bit of VIX exposure yesterday in the members section. Now, I'll say something about this trade, which is a little bit strange. I don't think this is the VIX trade I've been calling about, whereby we're going to get a huge spike to new all-time highs as the stock market comes tumbling down, right? I don't think we're there yet. Now, of course, if the stock market does indeed morph into one of these looks, then happy days, okay? We will profit from the VIX and we'll lock in the profit on the way down from the stock market trades. But I don't think that's what's at play here. I actually think I just couldn't resist taking this trade because I only needed about 1.5 points of stop. And I think conservatively, if we continue to pull back into those cycle lows for the stock market over the next week or so, then I could see this thing popping back up, something like this, okay? And then 4 or 5 points of upside will be locked in, and I would have only risked 1.5 to get that. So that'd be a nice quick little pop up and down. I kind of expect this to happen, okay? As ever with the VIX, when I'm long the VIX, I always want to be stopped out because I want the rest of my positions to continue to rise. The VIX obviously moves inversely to risk. So I want to see this thing, a little pop up, lock in the profit and roll over to new lows. And then we can talk about the VIX trade that I've been going on about forever. Just in case, okay, that really was the top in the stock market and we really are about to break down aggressively, then at least we will be able to catch some VIX upside out of the back of this trade. Gold looks like it's well on its way to that weekly cycle low timing window now, so happy days there. Some level of counter trend bounce makes a lot of sense, but ultimately it is about finding the daily and weekly cycle low inside that timing window and then getting back to some long exposure for gold. if by the time we get into this weekly cycle low window, we are at a demand destroying event, big bear market, stock markets are imploding, that kind of thing. It's not a call. Okay, I'm just saying if that's what the backdrop is as we get down here, then I would largely expect gold to need another daily cycle to work itself out and plunge with it, because during crashes, correlations tend to 1, people will be forced to generate liquidity, and they will generate that liquidity by selling gold. So whilst this is still the base case, okay, we're going to have a nice sweet weekly cycle low to get behind in the not too distant future. Like I said, if we are in the middle of a big bear market recession, a black swan event, anything like that, then I won't just be blindly buying here. The expectation will be that we get significantly lower prices first. Ultimately, though, nothing changes. Here is the timing window in red, and we will be looking for a tradable low out of that timing window. The dollar, for me, continues to support a deflationary look, okay? It continues to suggest to me, right, that the writing is on the wall here, okay? And if we cannot see this thing break down and risk assets scream higher over the coming days and weeks, okay, if we can't see that almost immediately, then we are going to see continued dollar strength. And as that stock market comes down, okay, think about the mechanics of it. Investors are going to flee risk assets and hide in the Dixie. They're going to hide in the dollar, okay? And that is, of course, going to put an enormous bid underneath the dollar. And when I first drew this yellow squiggle, a lot of people said this was crazy, right? They said there's no way possible that this could be the path, but it's already outpacing my yellow squiggle, okay? Now, again, if you know what you're looking at here, this has all the familiar symptoms of a deflationary type shock brewing, okay? So something like this, daily cycle low, and another push, particularly if catalyzed by the stock market coming down from its third and final angle, then you better believe it's going to get deflationary very, very fast. Just something to keep an eye on. And whenever you mention the dollar strength and a big push like this, people laugh in your face at the moment because everyone is so convinced that there's one final leg to the downside, sub 100. Now, no one wants that more than me, okay? Believe me, nobody wants that more than me. But at the moment, it's really hard for me to say anything other than this looks like a confirmed 3-year and 15-year cycle low. We can then soon be scratching these off. Okay, I'm just waiting for one right translated daily cycle here, and then that's it. It's confirmed for me. So this looks quite concerning to me. And if it's not concerning to you and you're 100% sure of yourself it's about to cut down below 100, then you might want to just have a little conversation with yourself and figure out why. And last but not least, Bitcoin, okay? Long and strong continue to push. This grind upwards reminds me of two things. Number one, it reminds me of gold back here. Okay, we saw this pop up and every man and his dog was drawing these rising wedges and saying, oh, I know what happens here. This is going to break down. Okay, this is bearish. This is bearish. New lows are coming. And in real time, we tracked this and traded it. And we continue to stay on the right side of it. And I was saying, I've seen this plenty of times before and it can resolve to the upside. Now, this is exactly what I think is happening in Bitcoin. And we also saw a very similar thing, again, which we dealt with in real time back here, okay? A lot of people were drawing things like this for Bitcoin and saying this is a rising channel, which is bearish. It's not going to break to the upside. It's going to break to the downside. It's going to retest 25K at the time. And I said, no, we've just seen this in gold. I think it's going to do the same thing again. And now, when we fast forward to today, I believe that is the exact setup that we are building right now. I think what we're going to see, and originally I got this wrong because originally I was calling for like a pennant or a bull flag here, something akin to this for Bitcoin, okay? But I think what the market is showing us is one of these big bear trap channels whereby we grind up in here and then explode further to the upside. Again, a whole heap of people will be getting ready to short this thing to the downside, thinking the rising channel or rising wedge is bearish. But as I showed you back here, okay, we've seen it before, and I currently speculate that we're about to see it once more. And I posted something similar to this on Twitter a while ago. In fact, all the way back here, I was saying, I think something like this will play. And then most recently, we gave an update. And as you can see, if we zoom in here, okay, this would be that grind, okay, a little pop up gets everyone wrecked. Then we drop down into that cycle low, and then it should be party time for Bitcoin. And again, I make the case, okay, that this is not going to last much longer in terms of time. And we're going to have an extended bear market decline, not all the way down here, okay, but... But yeah, that's how I see it. So far, so good. Happy days, long and strong across the board. Bearish undertones, still expecting a recession, still expecting a bear market, still think the risk is deflation, still think unemployment is going to deteriorate, still think the consumer, which drives the business cycle, is in a lot of trouble. And therefore, we are not going to see economic expansion over the coming weeks and months. And as ever, I am open to being proven wrong. All I care about is staying on the right side of the trade, which so far we seem to be achieving. So I'm your boy Camel. I hope you have a fantastic weekend. If you're a level 3 member, look out for the members only video for you guys. Other than that, God bless. Cheers. Bye.
Camel finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. sticking to his guns in his money game. He's a bad